Okay, so last time we kind of briefly talked about what we're gonna do. So before we go into in detail, I just wanted to emphasize that comparing an income statement account with a balance sheet account, some students incorrectly using balance sheet account ending balance rather than the average of this its beginning and ending balance. So this is a mistake. Remember when we talk about, say, return on asset, we wanted to use the net income and dividing the average of the assets. And we say this average of the asset is actually equals beginning assets plus ending assets, right? And then dividing 2. And then some of the students wanted to either using ending asset or beginning balance to use as a denominator, and it's not correct because income statement accounts such as the net income account are measurement over a period of time, and we talk about analogies like a movie, right? It's kind of tell us what was and what is now, like we can understanding the what happened during this period. And then comparing to the related balance sheet account, for example, in this case, we want to compare the dividing assets. So this asset, if you use either beginning or ending, is just a snapshot of that status of the company. It's basically you took a photo. So basically, time perspective wise, you cannot use a movie to dividing a photo. In other words, that you cannot using a measurement to measure a period of time difference, dividing as of one snapshot as of the at one point of the time of the measure. Hence that we needed to convert one point of time of the measurement and into average over the period. Hence we needed to transform it to be over time measurement by taking the average of the beginning and ending balances. Okay, so let's see this one. So this is Under Armour's income statements. As we can see, other interest including the interest expense for 26 million. And then this is the balance sheet, and usually we wanted to presenting two year at least as a comparison for each line item. So first of all, we want to use a ratio to analyzing a company's risks. What kind of risk we are talking about? First of all, we wanted to look at the liquidity risks. Liquidity stands for ability to pay short-term obligation. The term also refers as the company's capacity or capability to sell asset quickly to raise the cash. And another risk we talk about is the solvency risk, which means the capacity of the company to meet its long-term financial commitment. And then in terms of liquidity, there's a 6 ratio that we can use. Receivable turnover ratio, and which is in chapter 5, is basically equals the net credit sale dividing accounts receivables. And the average collection period, we're using 350 days to dividing receivable turnover ratio. And the inventory turnover ratio is in chapter 6. It's basically we use the cost of goods sold dividing average inventory. And average days in inventory, we actually use 365 days dividing inventory turnover ratio. And current ratio equals the current asset dividing current liability, and asset test ratio equals cash plus current investment plus accounts receivable dividing the current liability. And all this measurement is actually measuring risks. What kind of risks? The risks of whether the company have ability to pay a short-term obligation, meaning short-term debt, and also whether the company has ability to sell its asset quickly to raise cash, especially this one, right? How fast can you collecting your outstanding receivables? How long took you to converting receivable to cash? And how quickly can you sell all your inventory and then turn your inventory become cash? And how many days your inventory lives in your warehouse? and how fast can you, what's the capability for you to pay off your current debt, right? And more restrictive measurement of such risks. And when we talk about solvency risks, we talk about whether the company has ability to meet its loan commitments in terms of debt holders. So first of all, we talk about a debt to equity ratio, meaning total liability dividing the total stockholder equity. And then we also want to look at time interest earned ratio, meaning that whether your net income plus all the interest expenses plus tax expenses, that the benefits of lending increase your leverage to expanding your rate of return, whether that in motivation can cover your interest expenses. Let's first say, so remember receivable turnover ratio measures how many times the receivable are collected during a year. So basically we want to use a net credit sales. Credit sale means that the sale is debit accounts receivable and credit revenue. If it's a debit, if the sales result in journal entry of a debit cash and credit revenue, this is not credit sale, right? Credit sale means that you trust the person who gonna pay you in the predetermined term, such as 2, 10, and N30, and therefore you're willing to let them to pay you later. So this is called a net credit sale, and then dividing the average accounts receivable that outstanding from beginning to the end and dividing 2. So Under Armour is 9.1 times of receivable turnover ratio versus Nike is 9.9 times, which Nike is much bigger than Under Armour. So whether this ratio high better or low better? So the answer is the higher the better, because a high ratio indicates that ability to quickly turn receivable into cash. A low ratio indicating that a company have a trouble to collecting their receivables. Okay, average collection period, which is a transformation of the receivable turnover ratio. Basically, we use 365 days dividing the receivable turnover ratio. We find that Under Armour takes 40 days to collecting outstanding receivables, and Nike only uses 36 days to collecting outstanding receivables. In other words, the shorter the period is better, because the shorter period typically means more desirable, because we wanted to maximize the speed of cash inflows. And inventory turnover ratio, similarly a concept that it measures how many times the average inventories are sold during the year. And of course, it's gonna equals the cost of goods sold dividing average inventory. It's 2,585 dividing the beginning inventory plus ending inventory dividing 2. And then we find actually Under Armour turnover the whole inventory 3 times a year versus Nike turnover their inventory 3.8 times a year. In other words, a high ratio of inventory turnover indicates that the inventory is selling very quick, and an extremely high ratio might indicating lost sale due to inventory shortages. So in other words, inventory turnover ratio, it can be good in terms of a high, but if it's too high, for example 20 times a year, that's a little bit too extreme. In other words, this could indicating that this company's inventory management is not good, because it seems like you always sell out all your inventory too fast. In other words, you might have a shortage problem. So therefore, if you have a shortage of problem, that you will lose sales, right? Sales to your competitor, because when people really want to buy your product, you cannot provide them. Okay, and then average days in inventory is almost similar to the average days of the accounts receivable. So we use the 365 days divided inventory turnover ratio, and we find and Under Armour is 121 days, and Nike is 96 days. So inventory ratio and the resulting average days inventory vary significantly by industry. Okay, So for example, compared to the sporting goods apparel, which is Under Armour and Nike, their industry, and the dairy industry or food industry with perishable products will have a much high inventory turnover, and much low average days of in inventory, right? Because we cannot afford our inventory putting on shelves too long, because you're gonna lose all the value. So inventory turnover might even vary by product within the same company. So for example, if you are in dairy company, you probably will have a much shorter average turnover ratio versus the cheese that maybe have a relatively longer time. So in other words, if same item, same kind of product in the same company, it's the shorter the better, the average turnover ratio, average days in inventory, because it's quite expensive for companies to store inventory for very long term of time, and the higher ratio can be an indicator of slow sales, right? Okay, and then now we wanted to look at the company's ability to pay their current debt, which is a liquidity issue, right? So liquidity. So it's usually equals current asset dividing current liability, and Under Armour equals 2.921, and Nike is 2.921. Okay, would a company want a high current ratio? Absolutely yes. This is not like inventory turnover ratio or average days in inventory. It could mean something else. But when you ask, does current ratio a good thing? Yes, it is. A high ratio indicating company have a sufficient current asset to cover its current obligation. However, a high current ratio is not always a very high, say like 22%, 22 to 1, or 50 to 1. So it's not always a good signal. A high current ratio might occur when company has difficulty to collecting receivables or carry too much inventory, because the current assets here including inventory and accounts receivable. So if this one is too high, so 50 to 1, that means that analysts could, financial analysts, which is rating recommendation to outside people whether it's a good idea to buy that stock. Those analysts become very concerned when they see a very high, extremely high current ratio. It's because if a company reports an increasing trend of current ratio combined with either low receivable turnover ratio or low inventory turnover ratio. And asset test ratio is equals to cash plus current investment plus accounts receivable dividing current liability is equals 1.3 to 1, or Nike is 1.8 to 1. So asset test ratio is very similar to current ratio, but it's more conservative, right? Measure of current ratio available to pay the current debt, specifically the top part of a fraction including only cash, right, current investment, and accounts receivables, because it eliminates the current assets such as inventories or prepaid rents that are less readily to convert into cash. The asset test ratio often provides a better indication of a company's liquidity than does it the current ratio, right? Okay, so in other words, the elimination of low cash convertibility of the current assets such as inventory and prepaid expenses, it can provide a more precise and more conservative indication of company's liquidity. Okay, and then we wanted to look at a solvency risk, means that ability to pay long-term debt, right? Then we wanted to look at first of all, the risk of bankruptcy ratio is debt to equity ratio. So it means that this ratio is for example, the higher the higher debt to equity ratio means the higher likelihood of filing bankrupt, right? So would a high debt to equity ratio indicating low or high risk? It indicating high risk, right? Because high obligation, when this ratio is high, for such as Nike, it's a highly levered. It means a higher obligation to pay, right, comparing to the equity. So it means higher risks. It is also a measurement of solvency, or its company's ability to pay its long-term liability. And then we also talk about in chapter 9 that times interest earned ratio is comparing the interest payment with an income available to pay them. So we know that whenever there is interest expenses due, we need to use net income or interest to cover those interest expenses, right? Hence that we want to, we're creating this measure called the times interest earned ratio is equals net income plus interest expense plus tax expenses and dividing the interest expenses. So Under Armour is about 15.9 times interest earned ratio, and Nike is actually 83.8 times interest earned ratio. So is this ratio high good or low good? The answer is that the higher the better. A company wants a higher net income before interest and taxes in relation to the amount it's needed for interest expenses alone, right? So as we can compare Under Armour and Nike, we find that Nike is really high because because that means that Nike's ability to make money to cover its interest expenses is almost 70 times more than Under Armour. But in general, both of them have a good net income times the interest earned ratio. Okay, we categorize risk ratio into liquidity ratio and solvency ratio. And liquidity ratio focuses on companies' ability to pay current debt, and solvency ratio focuses on a long-term liability. And which of following consider liquidity ratio? And we wanted to say is actually receivable turnover ratio. Remember, because the faster the receivable converting into cash, right, the likelihood of you able to pay your current debt is higher. That's why it's a liquidity ratio. Okay, so which of following is the solvency ratio? It's a times of interest earned ratio. Is the higher that the net income before tax and the interest, the higher dividing to the interest in income, the more times of interest earned ratio, the better that the net income can cover interest expenses. And then besides to analyzing a company's risks, now we wanted to find out what kind of a ratio can analyze company's profitability. So there's a couple here. So first of all, in chapter 6, we talk about gross profit ratio, which is gross profit dividing net sales. And in the long-term asset chapter, we talk about the return on asset. We talk about profit margin and asset turnover ratio. And return on asset is equals to net income dividing average total asset. And profit margin equals net income dividing net sales. And asset turnover ratio equals net sales dividing average total assets. And the return on equity and earnings per share and price earning ratio is actually conveyed in chapter 10 when we talk about the statement of equity, right? Stockholder equity. And we know that return on equity is measuring on $1 of investment from common stockholders, how much they can, how much this equity is turning into net income. And earning per share is a very important indicator of, as a stockholder, whether this company are making enough returns, right? At the same time, price earning ratio is to look at how market think the potential of the company in future earning ability. and then we say there's a stock is a value stocks, and there's a stocks is a growth stocks. So in terms of growth stocks, people seems to consider this company have a better future earning ability, hence that the price earning ratio is pretty high. But for the value stocks is the stocks that are undervalued by the market, that the earning ability of the future is considered relatively low, comparing to growth company. So let's dive a little bit into it. So gross profit ratio indicating the portion of each dollar of sales above its cost of goods sold. For example, gross profit ratio for Under Armour is about 46%, and Nike is 45%. In another means that for $1 of net sales, the gross profit is about 46%. 46 cents goes to the gross profit. So in other words, that we're calculating this growth ratio, which is this net sales is equals all the sales minus the sales discount, sales return, and sales allowance, all kind of sales contingencies, and then we end up with no net sale, and the gross profit is equals sales minus cost of goods sold, right? So gross profit ratio varies considerably by different industry. With gross profit ratio of 46.4, Under Armour sells its merchandise for about twice what it costs, right, to produce. In comparison, Nike has a gross profit about 45%. Nike's good gross profit is still quite high, but not as high as Under Armour. And regardless the difference between two companies, the both are having in the range of apparel industry's gross profit ratio. And the gross profit ratio normally declines, right, when there's a high competition. For example, a patent drug can sell for many times its production cost. However, when the patent expires, competition comes to the picture. Hence, the company has to drive down the price. And then, if I ask you a true or false question, gross profit ratio vary by industry. Yes, retail typically have a smaller gross profit ratio than drug manufacturer, because retail is more competitive than the drug industry. So let's look at the return on assets. It measures the income of the company earns on each dollar of invested assets. And as we indicated earlier, that this asset here is actually an average of total asset. And then as we can see, the Under Armour have average return on asset about 8%, and Nike have a 19%. Of course, is a higher or lower percentage better in terms of return on asset? Higher, right? A higher percentage means that a higher amount of earned compared to the asset that it's owned. And the return on asset, remember, we tested in the exam 1 to break down into two ratio is actually profit margin multiplied asset turnover. And then we also indicated that the profit margin equals net income dividing net sales, and asset turnover is net sale dividing average total assets. So some companies are relying on the high profit margin to bring up the return on asset, but some people relying on high asset turnover to increasing the return on asset. And investors are highly desire company that have maximizing both. So I give you example like Saks Fifth Avenue or Tiffany's. They probably are relying highly on the profit margin rather than let's say Dollar Tree store. They are more likely to rely on asset turnover to make money. And then when the company do both very well, such as Apple, which have a high profit margin plus high asset turnover, it is highly desired by the investors. So measure, how do we calculate profit margin? As we indicated earlier, it equals net income dividing net sales. And Under Armour is 5.3% and Nike is 12.3%. So of course, a higher profit margin indicating a higher amount actually earned comparing to total revenue. And also, Under Armour has a profit margin of 5.3, meaning that for $1 of sales, a little more than 5 cents, okay, goes to the net income. On the other hand, Nike has a much higher profit margin. So therefore, if we needed to, but this is not to concluding whether the investment is actually giving enough return, because remember, a profit margin needed to multiple with the asset turnover to calculating the return on asset, right? So therefore, we also needed to pay attention to asset turnover rate. And asset turnover here is net sale dividing average total asset, which is 4,825 dividing total average asset. For Under Armour and Nike, they are exactly the same. So you're asking whether this ratio is the higher the better. Of course, the higher the better. The company wants a higher revenue comparing to each dollar is invested in its assets. So return on equity is another way to evaluating the profitability, right? It's measure the income earned for each dollar in the stockholder equities. So for example, Under Armour, it have a 13.9% return on equity and Nike have a 34.4%. Would you want a higher or lower ratio in terms of return on equity? Of course, if you are investors, you want a higher amount of earned comparing to the invested made by the owner of the company is more desirable. So Under Armour has the 13.9% versus the Nike have a 34.4%. Why is that? You can see maybe the Nike is almost like 11.1% higher than Under Armour, while its return on equity is about 20.5% higher than the Under Armour. The answer to relate to the is because there's a high financial leverage, right? Nike have very high financial leverage. Remember, it was almost like 89.9% when it's a liability dividing equity, Nike. Okay, the amount of debt that each company carries, right? So recall that Nike have a very high debt to equity ratio, and the debt to equity can be very good for the company as long as the return on investment exceeds the interest cost of borrowing, which is a times interest earned ratio. Remember, this ratio for Nike and Under Armour are both very high, right? So therefore, Nike not only can make enough net income to cover its earned interest, at the same time its financial leverage is really high. In another word, that Nike is very good at using the lever to expanding its production. At the same time, it can maintain really good profit to cover the long-term and short-term obligations. So therefore, Nike have very high return on equity. So in other words, for $1 of investment by common stockholders, Nike can make much higher return, 34.4, because Nike have very high leverage. They are very good at using debt to financing their operation. So in conclusion, both Under Armour and Nike enjoys return well in excess of interest cost borrowed from the creditors. By carrying a greater debt, Nike is able to provide a much higher return on equity in relation to its return on assets. So because Nike's return on asset, remember, is only 11.1%, oh yeah, it's not only 19%. However, its return on equity is 34.4. So 34.4% minus 19% is about 25%, right? So return on equity is much higher than return on asset because Nike are very good at using leverage to financing its operation. Hence, that the equity holder enjoyed much better return after paying the obligation to the creditors. Okay. So price earning ratio is really fun ratio. It compares the company's share price with its earning per share. And then Under Armour is about 64.6. However, Nike is only 20.7. And then in other words, when we look at the PE ratio, a higher PE ratio indicates that investors have a higher expectation for future earning for the company. And here I wanted to indicating that when we discussed in the chapter 10, which you will learn soon, is that investors pursue two basic type of stocks, right? I kind of mentioned a little bit: growth stocks versus value stocks. Right? Growth stocks like Under Armour is like people have a very high expectation of their future earnings growth. Therefore, usually they are traded at a much higher rate than their earning per share. Okay, and the value stocks have a little bit relatively lower, such as Nike is a value stocks. It have a lower share price in relation to its fundamental EPS ratio, right? And therefore traded at a relatively lower PE ratio. Value stocks are said to be good stocks at a great price, right? So this is a great price. And then the growth stocks is a good stocks at good price. In other words, you pay good price, you pay a lot of price, right, to get a company, the stocks to hold. And then if it's a value stock, is you paid a really great price, means that you bought things more than what you paid for stocks, right? Some investors take a strategy of picking growth firms, some picking value firms, and then the combination of both is more desirable choices. Okay. So profitability ratio measures earning or the operating effectiveness of a company over a period of time, such as a year. And investors view profitability as number one measure of company success. Okay? Earning per share and return on asset, ROA, earning per share, and PE ratio. Right? All those are fundamental measurement of earning ability and return on equity. This is very important. Okay. Okay. Sportstone reports a net income of 50,000 and net sale of 500,000 and average total assets of 400,000. What is asset turnover? Asset turnover equals net income dividing sales average total assets. Asset turnover ratio is actually equals sales dividing average asset, which is 500,000, right? Dividing 400,000, so it's going to equals 1.25%, right? Average. This is asset turnover ratio. Okay. Yes. Okay. And then what is the profit margin? Profit margin is equals to net income dividing sales, total sales. So that's the profit margin. Right, net income is 50,000, and dividing average sales, it's gonna be 500,000, hence it's gonna be 10%, right? Okay. And then what is return on asset? Return on asset is equals to net income dividing average assets, and then it's equals to 50,000 dividing 400,000, which is gonna be 12.5%. Okay. Okay. So I will talk to you in another video about how do we measure the earning persistence and earnings quality. I will see you in a bit. Thank you.